Imagine driving a car on a fast, modern highway. You can look out the windshield to see exactly where you are going. You see the road ahead, the curves, and the destination. But what if there was more to the story? What if you also had a precise, high-tech dashboard? One that tells you not just your current speed, but whether you are accelerating or starting to slow down before you even hit the brakes. Professional traders use a similar dashboard. Professional traders use something exactly like that. It is called the MACD indicator. It is one of the most popular and reliable momentum indicators in the entire financial world today. And today, we master it together. Used extensively by retail traders, professional investors, large hedge fund institutions, and market professionals. It is a staple on every professional trading desk. It is the pulse of the market momentum. Today, you will learn exactly how the MACD works under the hood, what it measures, how to read it correctly, and why many traders misunderstand it completely. Let's begin the journey into market mechanics. Part 1. What is the MACD? MACD stands for Moving Average Convergence Divergence. The name itself sounds highly complicated, technical, and perhaps a bit intimidating to beginners just starting their journey. But the core idea is surprisingly simple. Convergence means moving together, and divergence means moving apart. MACD helps you measure momentum, trend strength, and direction with mathematical precision. Think of MACD as a momentum detective. Its primary job is not to predict the unpredictable future, but to help you identify subtle shifts happening beneath the market's surface right now, clues most people miss. Just like the RSI we covered earlier, MACD is not magic. It is a highly mathematical and practical tool, and like any tool, it is only valuable when you understand how to use it correctly in high-stakes environments. To truly master the MACD, we must first break down its individual parts and see how they interact with each other. Understanding the components is the first step to true professional mastery. Let's open the black box. Part 2. Understanding the three parts of MACD. The MACD indicator consists of three separate components that work together to provide a clear picture of market momentum and direction. First, we have the MACD line. This is the heart of the indicator. It represents short-term momentum by comparing two different exponential moving averages, usually the 12 and 26-day EMAs. It is fast and reactive. Second, we have the signal line. This is a 9-day EMA of the MACD line itself. It acts as a trigger for buy and sell signals and serves as a reference point for momentum changes. It is slower and more stable. Third, we have the histogram. The histogram visualizes the exact distance between the MACD line and the signal line. It is perhaps the most undervalued part of the indicator for many beginners, but vital for pros. To simplify, think of it like a race between two runners. When one runner pulls ahead, the gap between them grows. This is what the histogram is measuring on your chart every single second. The distance of the lead. When the runners move closer together, the gap shrinks. As the gap widens, momentum is increasing. As it narrows, momentum is slowing down, signaling a potential shift in power is coming. Watch the gap. Part 3. The MACD crossover. One of the most popular and widely used signals the MACD generates is the crossover. This is often the first signal beginners learn to spot on a live chart. A bullish crossover occurs when the MACD line crosses above the signal line. This simple cross suggests that the upward momentum is starting to build significantly in the market. It's an invitation to look closer. Conversely, a bearish crossover occurs when the MACD line crosses below the signal line. This indicates that the downward pressure and selling momentum are beginning to take control. A warning to protect your capital. Notice we use the word suggests. Professional traders think strictly in terms of probabilities, never absolute certainty. They know a crossover is not a guarantee of a price move. It is a statistical edge. It is simply one piece of evidence in a much larger puzzle. The most successful market participants never rely on a single crossover signal to enter or exit a major trade. They build a case like a lawyer. Part 4. Why momentum changes before price often does. This is a fundamental concept in technical analysis that many fail to grasp. Let's return to our car analogy to make it crystal clear. Imagine a car driving at a very high speed. Before that car can come to a complete stop or turn around, something physical must happen first. The car must slow down. Deceleration precedes direction. Its momentum changes long before its actual direction changes. Financial markets behave in the exact same way. Momentum is the lead indicator for price direction. Find the momentum, find the trend. Before a major price reversal occurs, the underlying momentum of the current trend usually begins weakening. The MACD is designed to catch this subtle weakening phase. It's your early warning radar. This is precisely why the MACD indicator attracts so much attention from professional institutional traders. It helps you identify these invisible shifts before they show up on your P&L. Part 5. The power of the histogram. Many beginners make the huge mistake of ignoring the histogram entirely, focusing only on the lines. But the pros know that's where the secrets are. The histogram acts as a highly sensitive gauge of momentum speed. When the bars grow larger, it tells you that momentum is aggressively accelerating in that direction. The wind is in your sails. When the bars begin to shrink back toward the zero line, it is a clear warning that the current momentum is fading fast, even if the price is still moving in that direction. The fuel is running low. Think of it like a fire. A growing, healthy fire produces tall, powerful flames. A dying fire produces smaller ones. The histogram visualizes the firepower of the market trend. Can you feel the heat? Part 6. MACD Divergence. Now we arrive at one of the most powerful and advanced concepts in all of trading: divergence. This is where the real professional edge is found. This separates the masters from the amateurs. Imagine a stock price climbs to a brand new high and then makes an even higher peak. To most, price looks incredibly strong, but when you look at the MACD, it fails to make a new high. Something is wrong. This is bearish divergence. The price is rising, but the fuel, the momentum, is dying. The opposite is bullish divergence, where price hits a new low, but MACD starts rising. A hidden reversal signal. Divergence is not a direct prediction, but it is one of the most reliable warning signals for smart money traders. It tells you the trend is likely nearing its end. Prepare for a shift. Part 7. The biggest MACD mistake. The mistake that wipes out most beginner accounts is treating MACD like an automatic green light or red light machine. It's not a video game. It's high finance. They buy instantly on every bullish crossover and sell immediately on every bearish one. But indicators only work effectively when you combine them with proper market context. Signals need confirmation. You must always analyze the overall trend, key support and resistance levels, and volume. Trading MACD without context is like reading a single sentence and assuming you know the whole book. You're blind. Part 8. How professionals actually use MACD. Master traders rarely ask what MACD is saying. Instead, they look at what the overall market structure is telling them first. Context is king. They combine MACD with higher time frame analysis, volume profiles, and candlestick patterns. This is how they build a high-probability trade setup, stacking the evidence like building a skyscraper. Part 9. The big lesson. The ultimate takeaway is simple yet profound. Momentum matters. Strong, healthy trends require strong underlying momentum to sustain themselves in the long run. When momentum begins to fail, the price trend is almost certain to follow shortly after. In the financial world, having accurate momentum information is one of your greatest assets. Protect it. Your homework challenge. Open 5 of your favorite stock charts today. Apply the MACD indicator and carefully study past crossovers and divergence patterns. Train your eyes to see the invisible. You have completed episode 11. Tomorrow, we move beyond indicators and begin learning essential chart patterns. Subscribe to Wealth Entertainment 21 and turn on all notifications now. Don't miss a day. Follow us on Instagram at @sayayed.growth for daily insights. Remember, price shows what happened, but momentum reveals how strongly it happened. I will see you in episode 12. Stay disciplined.